Yeah, different hairstyle, all good. All right, you lot, time to have a little chit chat about property. How many of you have looked at the property market recently, felt a mild wave of despair and quietly accepted that buying an actual house might either require a lottery win or a time machine back to 2005? Yeah, thought so. House prices in most major cities are at levels that would have been considered science fiction 20 years ago. The average deposit required to buy a home in the UK, Australia, or the US is now well into the tens of thousands for most people. And getting on the property ladder increasingly feels less like a life milestone and more like a punchline. But here's what most people don't know. You can invest in property, actual property, shopping centres, warehouses, hospitals, skyscrapers, data centres, even mobile phone towers without owning any of it, without a mortgage, without a deposit, without becoming somebody's landlord, without ever having to fix someone's washing machine at 11 o'clock on a Sunday night. It's called a REIT, and it's one of the most underused tools in the beginner investor's toolkit, and today we're fixing that. I'm Leo, welcome back to Financially Fit Millennial, where we explain this stuff without making your brain hurt. If you're new here, brilliant timing. Today's video is one of the most practically useful ones we've done. So let's get into it. What actually is a REIT? Because the name Real Estate Investment Trust sounds like something a solicitor would say while you're trying to sign paperwork. Here's all it is. A REIT is a company that owns and operates income-producing real estate. Think shopping centres, apartment buildings, warehouses, hospitals, hotels, data centres, office blocks, and even things like mobile phone towers and self-storage units. The company owns all this property and then it sells shares in itself to the public on the stock exchange, just like any other company. You buy those shares, you become a part owner of that property. The rents and income the property generate get paid to you as dividends. Think of it like a pizza. The REIT owns a massive pizza worth hundreds of millions or billions of dollars of property. They cut into millions of tiny slices and sell you a slice. The pizza keeps generating rental income. Your slice gets you a proportion of that income. And if the pizza gets bigger over time because the properties go up in value, your slice is worth more. The pizza analogy also works in the other direction. If the pizza shrinks, your slice shrinks. Just thought I'd mention that while we're being honest. The key thing that makes REITs different from just buying stocks is the dividend requirement. By law, in the US, the UK, and Australia, REITs must pay at least 90% of their taxable income to shareholders as dividends every year, by law. Not if they feel like it, not when things are going well, 90% legally required. That's why REIT dividend yields are so much higher than the average stock. The S&P yields less than 1.5% on average right now. Equity REITs are paying around 3.7% on average. Some are paying considerably more than that, and we'll get into that shortly. Right? Not all REITs are the same. They come in different flavors, and I use the word flavors deliberately because some of them are considerably more appetizing than others right now. Equity REITs, the most common type. These own and operate actual physical properties. You know what they own, you can see it, you could theoretically drive past it. Shopping centres, warehouses, hospitals, apartments, data centres. This is what most people mean when they say REIT. And the performance across equity REITs right now is really interesting. Data centre REITs, which own the buildings that house the servers running the entire internet, AI systems, cloud computing, gained 15.1% in the US in April 2026 alone, in 1 month, because demand for data storage is accelerating fast and isn't going anywhere. Healthcare REITs, hospitals, senior housing, medical buildings grew around 12% in 2025. Demographics alone make this a compelling long-term story. Aging populations need more healthcare, healthcare needs more buildings, REITs own the buildings. Industrial REITs, warehouses, logistics centres, the places Amazon packages live before they arrive at your door, grew around 8.5% in 2025. Mortgage REITs, this is a spicy one. So mortgage REITs, or MREITs, don't own property. Instead, they own mortgages and mortgage-backed securities. They essentially lend money to property buyers and collect the interest. The yields are extraordinary. We're talking average dividend yields of over 12% right now. That sounds amazing, And occasionally it is. The catch is that mortgage REITs are significantly more sensitive to interest rate movements than equity REITs. When rates move unexpectedly, their margins can quickly compress. They're higher risk, higher reward. Approach with awareness rather than blind excitement. The one type to currently approach with caution, office REITs. Office REITs, which own, you guessed it, office buildings, are currently the only property type sitting in negative territory for the year, down nearly 14% year to date in 2026. The reason is fairly obvious when you think about it. Remote and hybrid working didn't go away. Office occupancy in most major cities is still significantly below pre-pandemic level. Companies are downsizing their office footprints. An office building that's half empty generates half rent, which is not great if your entire business model is owning office buildings. Not unsalvageable. There are office REIT bulls who argue the sector is oversold and due a recovery, but going in with eyes open seems prudent. Okay, why would you choose a REIT over just buying property directly? Because plenty of people still prefer the bricks and mortar route. So let's be honest about what REITs offer that direct property ownership doesn't. Advantage 1, no deposit required. You can buy a REIT for the price of one share. Some REIT ETFs, which hold a basket of REITs, can be bought for under $100. Compare that to tens of thousands required as a deposit to buy actual property. The stamp duty or transactional taxes, legal fees, the survey costs. REITs let you get property exposure from day one with whatever you can spare. Advantage 2, instant diversification. When you're buying a house, you're completely exposed to one property in one location. If that area declines, your entire investment declines with it. A REIT or a REIT ETF might hold hundreds of properties across multiple cities and sectors. Your risk is spread automatically. Advantage 3, no landlord headaches. This one is underrated. When you directly own a rental property, you are responsible for it. Broken anything, your problem. Nightmare tenant, your problem. Leaking roof at midnight, your problem. REITs have professional management teams handling all of that. You collect the dividend income and none of the 3 a.m. phone calls. I cannot stress enough how valuable that is. Advantage 4, liquidity. Trying to sell a house in a hurry takes months. Solicitors, surveys, chains collapsing, buyers getting cold feet. With a publicly traded REIT, you can sell your position in seconds on the stock exchange. The money is in your account in the next few days. Property without the drama of trying to exit it. Advantage 5, regular income. Because of that 90% dividend requirement, REITs tend to pay dividends quarterly or even monthly. If you're building an income portfolio or you're approaching retirement and want cash flow, REITs can be very useful tools. The income is relatively predictable because rents tend to be contracted over multi-year leases. All right. I've been fairly enthusiastic about REITs so far. Let me now be honest about the risks, because there are real ones and you deserve the full picture. Risk 1, interest rate sensitivity. REITs borrow a lot of money to buy property. When interest rates are high, their borrowing costs go up and their profits get squeezed. This is why REITs had a rough period in 2022 and 2023 when rates were being hiked aggressively. As rates fall, which is the current direction, rates generally benefit, but they're more sensitive to rate moves than most sectors. Risk 2, they're not really defensive investments. Some people assume REITs are safe because property is tangible and physical, but publicly traded REITs can drop significantly in market sell-offs, sometimes by more than the broader market. In March 2026, when markets corrected broadly, REITs fell 7.5% in a single month, while the S&P fell 5%. The dividend is reliable, the share price is not. Risk 3, sector-specific risks. Office REITs and remote working, retail REITs and online shopping. Both of these were disrupted by structural changes that caught a lot of investors off guard. The sector you choose matters. Healthcare and data centers have structural tailwinds. Office has structural headwinds. Picking the wrong sector can offset the dividend income without capital loss. Risk 4, tax treatment can be complicated. REIT dividends are often taxed differently to ordinary dividends in various jurisdictions, and holding REITs through a tax-advantaged account like an ISA, a SIPP, a Roth IRA, or a super fund can make a significant difference to your after-tax returns. That's worth checking for your specific country and account type, not something to figure out after the fact. Let's talk about what's actually happening with REITs in 2026, because the picture is more interesting than most people realize. We'll focus on the US REITs to narrow the focus. The global REIT index is up 6.3% year to date in 2026 after a difficult April in 2025 where the sector fell nearly 10% on tariff fears. April 2026 saw a remarkable recovery. Approximately 91% of REITs had positive returns in that single month. Data center REITs are the standout story, up 15% in April alone. The reason is simple. AI requires computing infrastructure. Computing infrastructure requires physical buildings full of servers. Those buildings need to be built, cooled, secured, and maintained. REITs own those buildings. Every AI model trained, every cloud database updated, every video streamed is generating rent for data center REITs somewhere. Healthcare REITs continue to have strong structural support. The global population is aging. In virtually every developed economy, the proportion of people over 65 is growing. They need more hospitals, more care homes, more specialist medical facilities. Healthcare REITs own those facilities and collect rent from the operators. The one dark spot remains office. With hybrid working now firmly established across most industries, office occupancy remains stubbornly below pre-pandemic levels in most major cities. Office REITs are the only major property type in the red year to date. Whether that's a buying opportunity or a value trap depends on your view of how office use evolves over the next decade. Both cases can be made. I'd be cautious. All right, enough theory. Here's how you can actually buy a REIT, because it's considerably simpler than buying an actual house. Option 1, buy individual REITs. Just like buying a share, you open a brokerage account, search for the REIT by name or ticker, and buy as many shares as you want. Well-known examples include Prologis, which owns warehouses and logistics facilities, Welltower, which focuses on healthcare, and American Tower, which owns mobile phone towers and data infrastructure globally. The advantage of individual REITs is that you can target specific sectors you believe in. The disadvantage is you're concentrated in one company. If that specific REIT has a problem, a bad management decision, a struggling tenant, over-leveraged balance sheet, you feel it fully. Option 2, buy a REIT ETF, usually the better starting point. A REIT ETF holds a basket of REITs, sometimes dozens or even hundreds of them across multiple sectors and geographies. You get instant diversification across the entire sector for the cost of one purchase. Lower risk than picking individual names, and the fees on most REIT ETFs are low. Vanguard Real Estate ETF ticker VNQ is probably the most well-known US REIT ETF. It holds over 150 REITs across multiple property sectors. One purchase, broad exposure, sensible fees. The iShares Global REIT ETF gives you global exposure across the US, the UK, Europe, Asia, and Australia. For UK investors, REITs listed on the London Stock Exchange are a bit thinner on the ground, but they do exist, and holding them inside an ISA or a SIPP is tax efficient. For Australian investors, AREITs, Australian Real Estate Investment Trusts, are available on the ASX, and some are very well established. So how much to allocate? Most financial planners suggest REITs as a diversifying component of a portfolio, not the whole thing. Somewhere between 5 and 15% of a total portfolio is a common range for someone wanting property exposure without direct ownership. They complement equities and bonds rather than replace them. The income profile and property market correlation adds diversification value when sized sensibly. All right, so nearly at the end. So REITs, actual property, shopping centres, hospitals, warehouses, data centres, even phone towers. Without the mortgage, the deposit, the solicitors, the stamp duty, or any of the deeply unpleasant phone calls. Required by law to pay 90% of their income as dividends, instantly tradable, accessible to anyone with a brokerage account, with yields that dwarf the average stock. stock. Are they perfect? No. Interest rate sensitivity, sector risk, and the fact that share prices can be volatile are all real. But as a way of getting property exposure in a portfolio without needing to actually buy a property, for most people, REITs are the most practical answer available. If you want to check out how REITs would fit into your overall portfolio, go use the free portfolio builder at financiallyfitmillennial.com. It takes 2 minutes and it'll give you a sensible framework for thinking about asset allocation. Link in the description. All right, legends, subscribe if you haven't. Drop a comment below. Do you already own REITs, or is this a new territory for you? Definitely curious, and I'll see you in the next one.